Yeah, morning traders. We have a big week ahead as we come into month and quarter end. There's a lot of events that we still need to navigate through, so I'm going to go through some of those. And also then relate back to interest rate pricing and see how the market's positioned across the different curves that we've been watching. So what are we watching this week? Well, as I mentioned, we've got month and quarter end shenanigans playing through, repositioning, rebalancing playing through. One would suspect we may see a little bit of a better bid playing through in fixed income as people rebalance there. We'll see what happens. Apart from that, we've got the ECB forum playing through in Sintra. This is where the sort of big powerhouses of central bankers get together, talk about what's going on in different policies and bits and pieces. But Wednesday night, we're going to be hearing from Powell, from Lagarde, Oida, and also from Andrew Bailey on the Bank of England. So we'll be watching comments from there to see if that moved markets as well. Got a rise on core PC inflation in the US later on this week. And the interesting thing here is that the market is expecting core inflation to remain at 4.7%. Now, we are expecting that to trickle down into year end, but it's a slow grind, as we all know. And remember that the Fed, in their dot plot projections and their SEP projections, said that we are going to see their central case is that we see that core PC number coming out to 3.9%. So we do need to see it heading in that direction. And remember that 3.9% still gives you an extra 50 basis points of hikes to take that terminal rate into 5.6%. So we need to see it coming lower. The market would obviously love to see that lower than 4.7%, but that could have big implication for rates and also for the US dollar as well. People have been watching very closely in this slowdown and this slower growth momentum, not just in Europe, but also in China. And that's what we're going to be watching, is manufacturing numbers and service PMI numbers coming through in China throughout the week as well. Now, the market is expecting those PMI numbers, manufacturing numbers, to slow at a slightly slower pace. So a slight improvement playing through there. And the services numbers to slightly, coming in a slightly slower fashion there. Of course, we are craving further stimulus to play through, and I think we'll probably get it in the July Politburo, but something we're watching very closely. We saw the Hang Seng down about 4.7% last week, so under pressure, and we're seeing dollar CNH breaking higher. We've got inflation reads in Australia, Europe, Canada, and also in Tokyo, in Japan. Now, the Tokyo numbers are sort of relayed 1 month ahead of the national numbers, so we're watching those very closely indeed. But I think it's the Aussie ones that I think will probably get the lion's share of attention. Now, these monthly reads here for the May number cover about 2/3 of the quarterly CPI basket, and we are expecting that to come down to about 6.1%. It's a seasonally soft period, but we are watching for travel costs and other factors to take that inflation read down to 6.1%. In the UK, obviously, everyone's been focused on what's happening in the mortgage market, in the housing situation. People talking about banks' asset quality, very, very lofty, high return on an equity guidance we've been seeing from various companies. But Barclays, NatWest and Lloyds under big pressure at the moment. You can see them in free fall, and you can see that gilt curve cratering at the moment and going to deep inversion. So we are watching those nationwide house prices in the UK. We're watching mortgage approval numbers quite closely. On the Swedish Riksbank front, the central bank front, we see them coming out with a meeting later this week. The economists are firmly of the belief that we get 25 basis points, but the market's actually pricing 38. So we could see some volatility playing through in the Swedish krona as well. So a lot to watch out for. We're also watching liquidity fronts as well. We know that the European banks are going to voluntarily pay about 30 billion euros of loans back to the ECB, and we've still got this big TLTRO repayment playing through. We've got a huge amount of bond issuance playing through, both in coupons and also bill issuance, and that could suck some liquidity out of the market. We'll see what happens in terms of who takes that, whether it's going to be RRP balances or reserve balances. And QT should really step up as well. We've seen about 24 billion so far from the Soma portfolio of that sort of 95 billion. So we're expecting QT to ramp up this week. Now, what are we seeing in rates? Let's have a look at where we're positioned. We can go into Fed funds or US swaps at the moment, and you can see currently sitting at 525 for the 26th July FOMC meeting. So that gives us 18 basis points of tightening being effectively priced in there. So that's a 72% chance that the Federal Reserve raise rates at that meeting. Now, I think that the strong possibility is that they raise 25 basis points at that meeting, and then that's pretty much them done. And you can see that reverberated in the curve going forward, where we see a market fully discounting that rate hike by November. So the market's saying, well, we're probably going to get one more hike from the Federal Reserve. That data's then going to soften, and that's them done for an extended period. So we're obviously watching that core PC. Apart from that, we do have durable goods numbers, new home sales, consumer confidence numbers. It's all sort of tier 2 stuff, really, until we get the non-farm payrolls number on the 7th of July and the next CPI number coming through on the 12th of July. Obviously watching Fed speakers as well. In the UK, obviously it's all about rates playing through. That's been the big movement we've been seeing so far. Now we do have 40 basis points of tights being priced for the 3rd of August meeting. We talked about the data flow that we've got there as well. But I think looking forward into that meeting, we're going to be watching the employment numbers that come from the 11th of July. That's the sort of forward-looking indicator. And then on the 19th of July, we get the CPI number, and that should really give us a good understanding. But I think a 50 basis point hike looks pretty much assured from the Bank of England at this stage for that August meeting. And that takes us to a sort of a terminal rate at the moment of 6.19%. How will the consumer sort of fare with that situation playing forward? Obviously, sterling looking pretty good at the moment on a trade-weighted basis, but certainly good gains against the Aussie and some of the sort of more cyclical currencies. In terms of Australia, obviously, we guys have talked about what's happening there in terms of the CPI numbers. We've got retail sales. Market's pricing 11 basis points for the 4th of July. That gives us about a 40% chance they hike at that meeting there. And that takes us to a terminal pricing by the end of the year of about 4.58. So that's where our cash rate is expected to sort of come up to. So we're watching that very closely. You can see the step ups as we go forward. But 11 basis points been priced there. And in Europe, we can see that market pricing 22 basis points for the July meeting as well. The ECB pretty much implicitly guaranteeing that situation playing through. You can see a terminal price really coming about 387 at the moment. I think we could probably get to about 4% on that terminal pricing, but something we are watching that euro very closely. We've got European inflation numbers, as we talked about, and consumer confidence, and obviously ECB speakers as well. So that's your interest rate wrap. Let's have a big week ahead. Trade at Pepstone.